This communication was prepared for educational purposes only and should not be construed as investment advice. All opinions or views reflect the judgment of the authors as of the broadcast date and are subject to change without notice. Julius Wealth Advisors, LLC, is a registered investment advisor. Our disclosure brochure, available at advisorinfo.sec.gov or through contacting us, provides further detail about our business, services, and fees.
By Julius Wealth Advisors.
Welcome to episode 10 of the Big Bo Show. On this episode, we're going to talk about the difference between a bear market and a recession, some historical facts on bear markets and recessions, and how this relates to my quest to make the best smoke brisket. And most importantly, why you shouldn't do what everyone thinks you're going to do and freak out. So sit back, relax, and enjoy episode 10 of the Big Bo Show.
Don't worry. Don't worry. I'm not gonna do what everyone thinks I'm gonna do. Flip out, man. All I wanna know is who's coming with me. Who's coming, man? Who's coming with me? Huh? Who's coming with me, man?
All right, let's get it going. Episode 10 of the Big Bo Show. We've made it to double digits. We started this show in January 2022, releasing about one episode per month, and we're sitting here on episode 10. Hope you guys have been enjoying it. It's been a very whirlwind of a year in terms of markets and investing and trying to create sustainable wealth. We are currently sitting here, and the S&P 500 is in what people call a bear market. Globally, we're also in what we call a bear market. S&P 500 is down 24% year to date. MSCI All Country World Index X, the United States, is down 27%. I know that's a mouthful, but I'm just trying to show you the difference between the globe and the U.S. since we do live in a global world. People are out there talking about a potential recession. So I want to try to go over for you the difference between what people call a bear market and a recession. Historically speaking, what this has looked like for creating sustainable wealth, and give you a little bit of practical advice as we enter this time that may be emotionally driven for many people out there. So first off, talking about the term bear market and talking about the term recession, there are two different terms. A bear market is when markets decline, depending on what market you're looking at. Again, either be the US, it could be the globe. But any market that declines by more than 20%, that's what people call a bear market. Now, there's a difference between a recession. A recession, if you give the classic definition by the National Bureau of Economic Research, or NBER, as many people might have heard, they state it is a significant decline in economic activity that is spread across the economy that lasts more than a few months. Now, historically, they said 2 quarters, greater than 2 quarters, but they kind of changed their definition to more than a few months. And a lot of times when NBER classifies a recession, they do it after the fact. Right? And this is a little bit of foreshadowing of something that we'll talk about later in the show. So I want to break up facts over fear, because in a time like this, there's a lot of fear, there's a lot of emotions, and I've talked about in the past, while it's very difficult by the way that human beings are wired, we need to try to separate our emotions when it comes to creating long-term wealth. So let's look at some facts here. This bear market, a concept of a bear market, is nothing new. In fact, since 1929, if you look at the US, the total US stock market as a whole, this will be the 16th time in our history that we've entered a bear market, right? And they happen for many different reasons. Now, the thing that we need to remember here is that in 9 of the past 15 bear markets, if you look at the US total stock market index as a whole, investors who stayed the course, who did not let their emotions get the best of them, made back all of their losses within a year after the trough of a bear market. Now, I know when people go out and they listen to the media, they read newspapers, or what have their friends, what have you. At times like this, people try to strike fear in people's eyes and minds. Okay? And I just want to let you know that, as we talked about previously in the Big Bo Show, I've been investing and learning about creating sustainable wealth since the age of 10. I've worked at some major institutions, talked with quote unquote some of the brightest minds in this industry. And I can tell you that I've never, in my opinion, have met someone that can reliably predict the magnitude of a market decline and the time it's going to take for a recovery. Everyone's going to be on TV trying to make predictions, newspapers trying to make predictions, your next door neighbor's going to make predictions. People come up to me all the time. Oh, Jason, what do you think the bear market's over? I tell them I don't know. Honestly, I don't know. I've never met anyone that can make a reliable prediction on when things will decline, when the decline will stop, and when we will have a recovery. I just look at the facts. I look at that this has happened before, situations that are going on right now. While history typically doesn't repeat, it often rhymes, as the saying goes. And don't forget that when people try to predict what's going to happen with markets, you need to be right twice, not just once. People think, oh, you just have to be right once. Well, no, you have to be right twice. You have to be able to predict when the market's going to stop declining, right? That's the first time. So you need to predict when you should have sold. And the second thing is you need to predict when you're going to buy back in. And most of the time, from my experience, no one's going to know when a bear market's over until after the fact. And maybe you were able to predict, oh yeah, I'm glad I sold, I'm glad I got out. But then the market's going to go up, let's just say 5%. And people are going to say, oh, that's a bear market rally. And then it's going to, and well, of course I'm not going to buy now, I'm going to wait for it to come down. And then it's going to go up 10%. And then 20%. And eventually you're going to get all the declines back. And then people that sold and were waiting for the quote unquote all clear signal, they're going to be still sitting on the sidelines. I've seen this before. I saw this during the financial crisis. I've seen this in previous bear markets during COVID, when the market declined sharply, and everyone's just like, oh, when's this going to end? And that was a great example of, well, what you saw was the market declined so fast and then it recovered so quickly. Again, nobody knows. Every single bear market is a little bit different. And what I would caution people to do is, like you heard in the beginning of the show, like Jim Brewer and Half Baked, don't do what everybody thinks you're going to do and freak out. Times like these are when what I call discipline squared, as I've told people in the past, to create sustainable wealth, I think you really only need 2 things: time and a whole bunch of discipline. And this is when having a whole bunch of discipline comes in handy. So what's some advice for long-term investors and younger investors? We talk to a lot of what I call HENWYs, right? I talk to a lot of HENWYs, or what I call high earners that are not wealthy yet, people that are trying to create sustainable wealth, that are in the beginning phases of their journey, and hopefully they're starting early, right? And then this is the time when you want to create good habits, because good habits are tough to create, but once you create them, they're also tougher to break. So When you're a HENWY, the advice to me is simple. You want to keep calm and invest on. The history of humankind has proven that people want to live a better life tomorrow that are living today. Yes, there are some bad people in this world, but I believe that most people are inherently good. Most people wake up every day and they say, wow, yesterday wasn't that great. How can I get better? Or even if yesterday was great, how can I propel myself and my family and my friends, my business, whatever? How can I propel that forward? And when people have this mindset, which I believe the vast majority of human beings have, and time and history has proven this, markets will get better. We just need to make sure you realize that these are tangible. Markets are tangible. They're people, they're businesses, they're governments. So again, framing that right mindset, framing those good habits. And again, I'll remind people of this. This simple fact is that when markets are down, which they are 24% and 27%, that's on average for total. So some businesses are down more. Some businesses are down a little bit less. But I will again tell you that when, right now, if you look at some of the retail companies, there's some excess inventory. So I keep on getting these emails, 20% off, 30% off. And they send these emails out to people and blast them to pique their interest. Hey, did you want this shirt before? Well, guess what? Now it's down 20% off. And listen, I'm guilty of it. I click into it and I look at maybe a shirt, or right now we're entering the winter up in the Northeast, a pair of sweatpants, 20% off. I wanted them before. Hey, maybe I'll look to buy it now. But when it comes to actually owning that company, that someone sent me the email to buy those pairs of sweatpants or buy those shoes or to buy that TV or to buy that computer that is now 20% off. When it comes to owning that business that's down 24% on average or 27% on average across the globe, people have the opposite reaction. Hey, you want to buy this business? It's 25% off. Oh, I don't know. It could go down more. Well, look at the business. Is it a high quality business? So again, have that opposite reaction. And if you're automating your habits and you're putting in a certain amount of dollar amount per month and trying to create sustainable wealth, well, guess what? That same dollar amount is now buying you more of that business. So if you're on the journey to create sustainable wealth, again, I will caution you to keep calm, invest on, block out the noise, don't freak out. Because in the end, this is what I like to call what people are real investors. And I'll break down this acronym of real. And I'll harness my inner Aaron Rodgers for this. When a few years ago, the Green Bay Packers started off slow. I think they might have started off 0-4 or 1-3. And everyone was peppering Aaron Rodgers. And people were like, well, what's wrong with you guys? This, that, and the other. What's wrong? And Aaron Rodgers sat back and he said, relax. Right? RELAX. Relax. So I tell people to keep it real. And what this means is relax. Everyone, act long term. REAL. Relax, everyone. Act long term. Be real. All right? Be real. And by doing so, you will not only be able to see through the cloud of the current storm, you'll be able to capitalize on some of the opportunities, because as history has proven, this too shall pass. So be real, and this should allow you to create long-term sustainable wealth. So let's take a quick break, and when we come back, I'm going to talk about the results of the recent Smoke Brisket contest that I entered within my neighborhood, and how that relates to the current environment.
Growing up, Jason Blumstein had become accustomed to a life of financial struggle and frustration. His grandfather, Julius, took the time to teach him the difference financial literacy can make. Since then, Jason has Julius to thank for pulling him out of the mud and pushing him to become empowered, educated, and independent. We want Julius Wealth Advisors to do the same for you. At Julius Wealth Advisors, we are committed to continuing the legacy of literacy and learning. Advising to us is much more than simply telling our clients what to do, it's teaching them how to do it. Our emphasis on client education is founded on the fact that we've seen its benefits firsthand. Our lives and our firm are built by the tools wise friends and family members have passed down to us, and our passion is to pass these tools unto you. Please call us at 201-289-9181 or email at info@juliuswealthadvisors.com to take your first step to be empowered to live your best financial life.
All right, so let's get into more facts versus fear. A lot of people out there are talking about the U.S. and the globe going into a possible recession. We talked about earlier the concept of a bear market, so let's talk about recession and what this historically meant and why. So, if you look at the past 7 recessions in the U.S. since 1973, you might be surprised to learn that in 5 of those 7 past recessions since 1973, the U.S. stock market, the total U.S. stock market as a whole, was actually up in 5 of those past 7 recessions. The returns were positive. Now, why? Right? Whenever we try to understand something, I always tell people, don't ask what, ask why. So why is this? In my opinion, this is because there's a concept called leading and lagging indicators. The stock market is what is known as a leading indicator, and sentiment and people's confidence are lagging indicators. So let's try to break this concept down by talking about me and my ventures into refining and getting better at smoking brisket. So I'm going to share a story with you. This past Sunday, we had a local smoke brisket contest. One of my neighbors set it up. We had people enter the contest and who can make the best smoked brisket. It was a blind taste test. People didn't know who made what. You had a vote, 1 vote per person. You didn't know how many tickets or coins people were voted for. And guess what? I won the contest. I came in first place in the contest. Now, the part that people at that contest did not know is that we had a small contest this past November on Thanksgiving with a lot of the same entrants. And I came in close to about next to last in that contest. Now, let's compare this to leading and lagging indicators and using my way of smoking brisket as a quote-unquote stock. So if you would say, I'm going to buy is Jason great at smoking brisket? So after that contest in November, when I came in next to last, my stock would probably have been crushed, right? It would have been down big time. But this is known as a lagging indicator because sentiment and confidence in my abilities were down. But this is the past. I already lost. But when you lose, most people, as we talked about earlier, want to get better, right? You don't want to be known as the person who makes the second to worst brisket. So what did I do? I started studying more. I talked to some of the other people that won and learned about what they did versus what I didn't do. I watched some more videos. I read some more. And these are all what are called leading indicators. These are all actions, an action plan of what I put together to try to get better. So as I was taking on this action plan, these are all leading indicators of if I was taking the right steps to get better, my stock would start to go up. My stock and my ability to smoke brisket, if you will, would go up. This is called a leading indicator, right? So now, winning this past Sunday, you would have already seen my stock skyrocket. My stock and how I smoke brisket would have skyrocketed. But again, this is now called a lagging indicator because I already won. Sentiment and confidence in me is already high. And What's going to propel my stock, if you will, and my ability to smoke brisket forward from now is going to still be the actions and steps I take to get better. So again, if you compare this to recessions and the market and leading and lagging indicators, the market is a leading indicator. They foresee we can go into a possible recession, stocks start to go down, confidence goes down, sentiment goes down, which is going on right now. These are all lagging indicators. But what's going to happen? No one can predict the future, but typically people try to get better. And when you're already in a recession or you're already in a bear market, these are all going to be leading indicators as people try to get better and live a better life. So again, don't always focus on what everyone is saying is definitely going to happen, because this is sentiment that's already forecasted typically as leading indicators in the market as a whole. Okay, so what I would tell you is that in life, in playing sports and trying to create sustainable wealth, and my ventures in smoking brisket, some of the things that I have learned is that things typically aren't always as good as people think they are, and things typically aren't as bad as people think they are. And as human beings, we are wired, right? If you study the human brain, we are wired to take the present and blow it up to what the future will look at. That's our ancestral brains, sometimes working for us and sometimes working against us. But we have to understand this, as our brains have evolved to react to immediate threats. So let's wrap up episode 10 of the Big Bo Show. There's 3 things that I want everyone to take away from the show. Number 1, don't freak out. Don't do what everybody thinks you're going to do and freak out. Number 2, the concept of leading and lagging indicators. The stock market, leading indicators. Sentiment and confidence, lagging indicators. And number 3, that I'm getting really good at smoking a brisket. So, with this all said, as always, I stress to people to live a life of integrity, live a life of knowledge, always trying to obtain as much knowledge as you can, and always live a life that you're passionate about. All the best.
Thank you for tuning in to the Big Bo Show.
Let's take a little flower and turn it into a tree. 'Cause we're harnessing the power that has been passed down centuries. Life in a game, fortune and fame. You're gonna win over time, you know. It's hard to attain, but you're on your way. You're listening to the Big Bo Show. Brought to you by Julius Wealth Advisors.